friends, Mohan here. In this video let we see about leverage. If you want to know about leverage, then we need to know about margin and lot size also. So in this video let we see all these things. A basic lack of knowledge on how to use leverage is often at the root of trading losses. The misuse of leverage is often viewed as the reason for these losses. When you trade Forex using leverage, you actually are able to control more money than the balance of your own trading account. The term comes about because with the broker's help, you are leveraging the money that you have. Using leverage allows you to increase your profits. Brokers are able to offer significant leverage ratio as high as 400:1. This means 400 times of your deposit money. For example, if you have deposited $250, the trader could control roughly 100,000 USD in currency on the global forex markets. Lot size and its values. Standard lot. One standard lot represents 100,000 worth of currency. One mini lot represents $10,000 worth of currency, and one micro lot represents $1,000 worth of currency. What lot sizes are worth in Euro USD? One standard lot is equal to $10 per pip. One mini lot is equal to $1 per pip, and one micro lot equal to 10 cents per pip. Margin. What is margin? Margin is the amount of funds that the broker requires from the trader in order to cover any open positions. If you want to trade one mini lot, that is 0.1, that is worth $10,000, and your broker is offering you 50:1 leverage. In order to control that 10,000 worth of mini lot, you will need $200 of margin from your trading account. See how the margin will be calculated. Let me see from this formula. Margin is equal to lot size divided by leverage. Here lot size should be the worth of the dollar need to enter. So for one mini lot is worth of $10,000, so we need to enter 10,000 divided by leverage. The leverage is 50. So 10,000 divided 50, we will hit 200. So this is the margin requirement to open a one mini lot size. You can take one mini lot size for $200 margin. So you can't take mini lot size if your account size is below 200, as your broker provides 50:1 leverage. Which leverage is good? So should a new currency trader select a low level of leverage such as 50:1 or the ratio up to 400:1? Say if you are driving a car with a maximum speed of 200 km per hour, is that a car more dangerous than driving a car with a maximum speed of 80 km per hour? So you are in control of the accelerator. The leverage is the accelerator, so only more dangerous if you step on it too hard. Let me see an example. The true traders having the same account size and using the different leverage size. The trader A using the maximum leverage of 50:1 which are provided by the broker. So he can trade up to 500,000 worth of lot size he can trade, and the trader B using only 5 to 1 leverage. He also having the same account size of trader A, but he using the only leverage of 5, so he using lot size 0.5, while the trader A using 5.0, 5 standard lot, and trader B using 5 mini lots. So if the trade goes against the investors by 50 pips, the investor A would lose 2500. This is 25% of the total $10,000 trading account. So that investor A risking 25% in a trade, it is not good. Investor B, should the investment fall the same amount by 50 pips, then the trader would lose 50 pips into $5 equal to $250. This is just 2.5% of the total position. It is a reasonable risk. So who choose the best leverage? The investor B choose the best leverage, and of course investor A choose a bad leverage. So think twice before choose the correct lot size. Be conscious on selecting lot size leverage while you trade, because leverage is the key of money management. Thank you. For more details, contact through